Money markets. What is a money market? Well, money market is a segment of the broader financial market which is characterized by several distinctive features. First of all, it is of very short term. As opposed to the capital market, which is of longer term, a money market instrument always has a maturity of 1 year or less, usually less than 1 year. Second, money market instruments require a high amount of upfront capital or initial investment. In the US, this is at least $100,000 US. That means participating in the money market is pretty much out of question for most average Joes or retail investors. This is because most of the instruments traded here or issued here are of very high quality. And by high quality, I mean low credit risk, low probability of a default. It is also a highly liquid market. By liquidity, we mean that the instruments which are traded here have ample number of buyers and sellers ready to participate at any given moment. That means whoever is in possession of one of these securities can almost immediately convert it into cash. Or if someone wants to buy, they can immediately find a seller. Some common examples of money market instruments are CDs or certificates of deposit, treasury bills or T-bills, treasury notes, T-notes, bankers' acceptance, commercial notes, etc. As you can guess, treasury comes from the government, so these are government-issued securities, which pretty much have no chance of a default. And the commercial notes or commercial papers are issued by private organizations, private firms. So they do technically have a little bit of a chance of a default associated with them. But remember I said only high quality firms are allowed to participate? That means that these companies are of extremely high quality. They have great credit standing, great credit rating. Think of companies like Starbucks or Walmart or Boeing, well-established companies with great reputation, great financial performance, and very low probability of not being able to honor their financial commitments. Money market is extremely popular and very important to the health of an economy. For corporate firms, it is a cheap and a quick way of raising short-term capital. The same goes for the government. For investors, it is a useful way of earning a little bit of an extra return for their cash. Because these are short-term instruments, their money is not getting tied up for a long amount of time. Now, the yield is not very high. The return is not high like longer-term bond markets or stock markets. It definitely pays better than holding cash. Cash, after all, gives you zero return, or negative real return if you account for inflation. So, in short, money market is an excellent way to park your cash and earn a little bit of an extra return. Now, remember that there is a high cost of entry associated with the money market. For retail investors, these markets can be accessed through money market funds. These are funds which invest in a big basket of different money market instruments. Small investors can buy units of these funds and therefore gain exposure to the money market. We will get into more details on these at another time, not in this video. Now, let us take a look at an example where we try to price a treasury note. When we use the term note as opposed to a bond, we mean a shorter term money market instrument. Bonds are longer term, notes are short term. So we have to value a 6-month, 180 days T-note to be bought at a 9% yield. The par value or the face value is $100,000 US. What will be the current price? Remember that money market instruments use a discounting method. They do not pay coupons. This is an important point. I repeat, Money market instruments do not pay coupons. Therefore, our only option is to use the discounting method. Take a look at this formula. It is pretty self-explanatory. F stands for the face value or the par value. Y is the yield. In our case, 9%. N is the maturity period, 180 days. And 365 is, well, the number of days in a calendar year. Plugging in all the information, we arrive at the result of 95,758 US dollars. Now, let's take a look at a bond. A bond is a longer-term debt instrument or a debt security. It is also called a longer-term promissory note. It is a promissory note because the issuer of the bond is promising to its buyer or its holder that they are going to pay back their principal amount plus a pre-agreed amount of interest every year. And this interest is usually paid on a coupon basis. It can be semi-annual, every 6 months, can be on a quarterly basis, every 3 months, or can be on an annual basis also. It pretty much depends on the issuer and their preferences. And of course, it is also possible to have a zero coupon bond where no coupon payment or no interest payment is paid in the interim. Instead, the entire maturity amount is paid when the bond expires or when it matures. So these are zero coupon bonds, which, because they do not pay any coupons, are sold at a discount. So if the bond is worth $100, the buyer would usually get to buy it for $92, $95. Bonds can be issued by a variety of issuers: the government, large corporations, even municipalities and state government, local government. The options are endless. Now, bonds can be secured or unsecured. When they are secured, it usually means that some kind of a collateral or some kind of a property is being pledged as a security, meaning in the case that the borrower or the issuer of the bond defaults, the holder of the bond is able to liquidate that pledged asset to recover some of their losses. Now, debentures, on the other hand, are unsecured. As I said, bonds can be secured or unsecured, but debentures are always unsecured. Like bonds, they are also longer-term debt. So for a debenture issuing firm, it is beneficial that they're not tying up a property as a pledge or as a collateral. So this allows them more flexibility. Of course, from an investor's point of view, this is riskier, but because of this higher amount of risk, they're also expecting to be compensated more. Now that results in a higher yield. So high risk, high return. Makes sense. On the other hand, an example of a secured bond or secured security in the debt market would be a mortgage bond. As the name says, it is secured by a lien on a real property. So ideally speaking, the value of that property should be greater than the amount of bonds which are being issued. Otherwise, the investors would be at a disadvantage. Another type of bond is a convertible bond. As the name says, they can be converted, but converted into what? Usually, they're convertible into the common stock or shares of the issuing company. So let's say, for an example, McDonald's issues a 5-year bond, which is convertible. At the end of those 5 years, the holder of that bond is given the choice. Do they want to receive the entire principal amount back, or would they prefer not to receive that cash and instead convert their bonds into shares of McDonald's? The holder would have a choice in this case.